Yes, thank you, Ola Christian, and good day, and welcome to this update with SKAGEN Focus. We thought this picture was sort of appropriate to begin with, this climb picture, since the last few months has really been about climbing a wall of worry for the global equity markets, and I think we all are surprised how fast and how rapid this re-rating has been over the last few months. In our case, it's more about climbing the wall of worry, if you will, since you well know we are value and contrarian investors. And this is, of course, this rotation we've seen in the last few months has really been met with skepticism and questions and so on. Can this be sustained? Is this beginning of a new trend? What is it? We'll touch upon these questions as we move along this presentation. We're also going to take a look at our portfolio positioning, and a new investment case at the end of the presentation. And we'll take questions afterwards if there's any questions. So first, we just want to show you this slide again. We know this is probably a repetition from earlier presentations, but we still want to highlight what SKAGEN Focus is about. What is our mandate? We are a highly concentrated global equity fund with an unconstrained mandate. We have the opportunity to invest in every geography, every sector, every cap size, but we are constrained by valuation. We need to see a 50% upside in 2 to 3 years without taking any historical growth estimations into account. We do like growth companies. We just don't want to pay for this particular growth. So we need to see our 50% upside on normalized or steady state earnings power. Now, our composition in terms of market cap size is pretty interesting right now, because we are at a record high in terms of small and mid cap exposure in the fund at 70% or above that, I think, actually currently, which is a result of the valuations and the opportunities we see. And we think that the dispersion between these mega large caps out there, especially in the US, and the small and mid caps, especially in the value spectrum, is getting almost ridiculous in terms of valuation differences. And the last few weeks, months has done some things to change this, but we think there's way to go. So the bulk of our new investment case has really been about small and mid cap value stocks in both the US and in Europe and Asia. Actually, we go through that later in the presentation. We can take next slide. So the key client message here. Our largest position is Roxgold. It's a gold miner. I think we have been through this in former presentations. It has, by its own merits, propelled itself into the top spot of the fund. It's about 7% of the fund right now, and it's a Canadian-listed gold miner with assets in West Africa. And we think this Seguela asset, which they bought just 2 years ago, is turning out to be some kind of Kinder egg. And we think this the current market cap of Roxgold is pretty much equal to only that asset. If that's true, that means we're buying the whole core operation or the ongoing operation in Roxgold for free, more or less. This is a net cash asset. And we'll go through at a later stage here the fundamentals of the gold industry, which we think is very interesting right now. Roxgold there is a high conviction name, or the highest conviction name actually, since it's the largest position in the fund. As I mentioned, we have a record high allocation towards small and mid cap stocks at almost 70% of assets. And this is a pure function of valuation. And also, I would say, in some cases, in these cases, the growth rates, many of these cyclical small and mid cap names will post over 20 depressed earnings base. We think 21 could be really good in terms of earnings growth for these names, even into 22 before things normalize. And remember, we value assets at normalized earnings power. So we can buy many of these names, the beaten down cyclical names. We have a few examples of these names later in the presentation at a very interesting discount, we think, right here. So we have 2 positions hitting price targets since our last update. We did have a very short but sweet journey in Disney. That's a large cap. You all know Disney. That's an exception to our sort of new holdings list. I think the only name that has been among the larger caps that we bought around $85-90 in mid-March at a 50 to 100 basis point weight in the fund. This rally 2 or 2.5 months later, the stock is trading at around our price target. So we have exited Disney. We can say perfectly timed, but not perfectly optimal weight in the portfolio. But the re-rating was so rapid, we never really got to increase that position. Fortuna Silver is one of our other precious metals engine in the fund, hitting briefly price target last week. We did initiate Fortuna Silver 1 year ago at 3.5 Canadian dollars, briefly traded at 7 Canadian dollars. Since the market now is clearly starting to appreciating the Lindero asset, their new gold mine, which will be operational at the end of this year. We initiated 2 new positions, both in the middle of the crisis or just thereafter. And one of them is US-based cement company Eagle Materials, which is a really interesting, it's a tale of 2 eagles, actually. We'll take a look at that. That's the case at the end of the presentation. We have German industrial Norma, which is a 1% position currently, a small cap in Germany. These guys are leaders in joining technologies. That's small components joining hoses, application, industrial products, where OEMs and trucks and so on are at the end market in many cases. Very interesting and cheap name, single source supplier in many instances, and has been very strong also since inception. We have seen the recent sharp rise in the NAV. I think we are up in excess of 35% since the lows, depending on currency. Has been very strong, and it's across the board. It's a function of these cyclical components, these value names, in combination with the precious metals names, have really been rising in tandem, and that has sort of propelled the portfolio higher. But we want to point out that there's still a very healthy upside to our conservative set of price targets based on normalized steady state earnings power, about 75% across the portfolio here. And this rotation we've seen, which may have just started, we don't know. If that's the case, that is consistent what has happened following dramatic declines in equity market values. Value is often, or deeper value actually, is often the asset class that would lead out from that kind of collapse in valuations and economic outlooks. And we have no reason to believe this time will be different. We'll take a look at detailing that view as we move along this presentation. So what has happened in the US as of late? We tend to focus more and more on the US when we see these presentations, because US is the market that is absolutely most extreme in terms of the dispersion between the mega large caps and the small mid cap names. You can go back one slide. You can see here the deep value basket versus the S&P 500. That is essentially stocks below one times book. Value is the more traditional value index in the US, and the extreme underperformance of value or deeper value since mid 2008 inflection point. You'll see that actually deep value did pretty well up until mid 2018. Now we've seen the subsequent collapse relative to other asset classes. In retrospect, these mega caps have risen while value has done nothing for quite some time. And you'll see the little blip here in the latest month or two, or actually it's been increasingly evident in the last few weeks that value has sort of started to work again. And of course, this is also a function of the S&P 500, if you could take the next slide, which is increasingly, or the US equity market is increasingly concentrated. The top 10 stocks in the S&P 500 is about 30% of the whole market cap. And this is historically these kind of concentration risks has meant something, and this time around it may mean that these companies have really starting to reach some sort of maturity stage where the law of large numbers really come into play, and the market needs to find other areas for value. It's even the top 10 stocks are even in excess of the 300 bottom stocks in the S&P 500 right now, which is clearly an extreme starting point for this movement. And also, you know that we track the Nifty 50, which are the 50 most expensive names in the MSCI All Country World Index. And you'll see this from the beginning of 18 versus the Thrifty 50, as we call them, which is a proxy of our own investment universe. That is the cheapest 50 names in the MSCI All Country World. This is a blend of price book and PE, these two baskets. And you'll see that up until very recently, this gap just has gone more extreme. The point here is that this only increases, we think, the opportunity for a rotation to what has worked over the last century from what has worked during the last 10 years, basically. Value investing has over time been the most profitable exercise, and we think this may be the time where the tide is shifting, so to speak. So we talked about gold, we talked about Roxgold, we talked about, and this chart really underpins our investment case in Roxgold that's the top position. The gold industry in itself is very underappreciated. We think it's sort of people find it sort of a strange part of the equity market. We find it not so strange. Gold has really been very strong during these last few months. Actually, the trend has been solid for a number of years, and it's now hitting, or did hit, $1,800 per ounce briefly, underpinned by these low rates and now the weaker dollar. So at the same time in the crisis, while the gold hits high, the energy costs did hit a low. This has been reversed somewhat. But the gold industry has never been more profitable than it is right now. And that's clearly something that's not only true for Roxgold, but for the whole industry. It's definitely a positive for assets that's been able to produce throughout the whole crisis, which has been the case with Roxgold. That is, they have had zero disruptions in terms of the COVID-19 developments. Fortuna Silver has been down for a brief period, now up and running again. So we think this is something that is highly underappreciated by investors, this industry, and these particular values we see. With Roxgold trading still, despite a rally of 35% this year, very cheap to earnings power. And just to show these names, our precious metal dynamic duo, as we tend to call them, Roxgold and Fortuna Silver, has really been strong since the market lows. Fortuna is up over 100% since inception, or did briefly hit that price target. While Roxgold was initiated around, I think, 80 Canadian dollar back in 19, now trading around 135 Canadian dollars. We have a price target of 250 there, so still a very decent upside. We think also Roxgold can be a part of strategic transactions in the gold space, since it's a very well-run asset with at the very low valuation, with a low market cap, net cash asset. So just to show you this chart, you may have seen this chart before, but it's still very relevant, and therefore we show it. If you focus on the red line, the clear red line and the clear blue line, you'll see that when the tech bubble, this really shows what happens following in the aftermath of a dramatic equity market decline. And following the tech bubble, indeed, you saw money coming out of the quality growth or the highest values companies, in that case, the tech companies, of course, on a global basis. This was not so much, this was a global phenomena rather than a US phenomena back in the day. But what happened was that value, especially financials, was very strong following that collapse. It was a rotation that came, and a couple of years later, value had posted a very decent performance record versus the quality growth names. And you'll see the same pattern from the global financial crisis, really more extreme, and probably a faster re-rating there, 2009 into 2010, very strong, while the quality growth names was definitely slower to perform. Then we know what happened. We had a QE, we had rates collapsing, and you started the era of quality growth names outperforming, and now the latest 2 years at an extreme pace. So this is sort of what's going on, and we have no reason to believe this time is different. Stars are aligning for value, we think. So if you go to the first point there, the massive monetary and fiscal stimulus that's supporting equity markets, which is one major reason of this re-rating, one should be wary about when these central banks remove these stimulus. That would be, and the market will of course suspect this, way ahead of the actual decisions. But as it looks, these fiscal and monetary stimulus are really supporting equity markets, and ironically supporting value and cyclical components, early cyclical components of the global equity market space, which has lagged tremendously over the last few years. The starting point is obviously extreme, since you have had this mega cap quality growth outperformance versus value assets. If you compare, for instance, an emerging market financials with the FANGs, that's an interesting chart. Maybe we should show that next time. That's the typical dispersion which you'll see, which might finally start to reverse, which would be very good news for our funds, since we carry both KB Financial and Korean Re, for instance, which are two very cheap financial names in Korea. I think we're going to see maturing growth rates in the mega large cap space. These guys can continue to grow, but I think the market may be disappointed, partly on how cyclical these names are. When you see that, if you take a look at Google's search engine, you have revenues collapsing in a weaker cyclical climate, which is many are not maybe prepared of, and you also have the difficulties with growing from a large base, which really should at some point make the rest of the market more attractive, and especially the ignored value parts of the market. And we'll see the cyclical components. Value is not only about cyclical components, but it's a part of the universe is definitely cyclical at this point. We have plenty of those names in the portfolio, and we think these will really post impressive growth rates from a very low base, of course, and definitely higher than the market on average, and in absolute terms, very, very, very impressive growth rates in order, for instance, mining and other parts of the value complex. So I think the conclusion here is that despite this latest 2 months of re-rating for our portfolio and for value assets, maybe in particular, we see significant potential for this to be continued, and I think clients should have at least a balanced style approach, or a balanced approach between what has worked and what may have beginning to work over the next few years. So that's the situation where we stand right now.
All right. So when thinking about this significant potential that we can see within the market, especially within global equity markets in terms of rotation and so, if there's one thing we want you to remember from this webinar about our fund, is that we run a contrarian and price-driven philosophy. We try to identify investment opportunities in markets where we see at least 50% upside. We look at our investment potentials with a 2 to 3 year horizon, and we value them based on their normalized earnings potential. So the phenomena that create these opportunities for us obviously constantly vary across sectors and geographies, which is where we benefit from such a broad mandate. And when we look for value, there's a wide spectrum in which our philosophy can be applied. You might recognize this chart from before. Jonas mentioned two of our latest additions to the fund, so Norma and Eagle Materials. So the chart below could be used to describe the characteristics of these cases. So if you take the German industrial company Norma, for example, as a classical return to mean value type of situation. They're an international leader in joining technologies. They're a single source supplier for most of their clients, which are based in the automotive and truck OEMs industry. Industry has been hit quite hard, and Norma would massively benefit from any type of recovery from here, and they're very well positioned to sort of ride that wave. Then we also have Eagle Materials, which is a US-based cement and wallboard producer that fits perfectly as an economic return value type of situation. The equity fell off a cliff in the beginning of March, despite some very interesting dynamics, which we will take a look at later. They're a low-cost producer. They have a unique advantage due to their positioning within the United States, where they're shielded from import pressures from competitors. They have a very attractive margin profile and a strong case we think we can see there for a normalization in the midterm with several catalysts to support it. So wide range of opportunities that constantly move across sectors and geographies, and we look for value. So given our price-driven philosophy and recent market volatility, there has been quite a lot of activity within the fund. As we mentioned, we added 2 new positions in the fund. We have increased our position in aircraft leasing company AirCap. The position has been quite strong since inception, as we started to see tangible signs that the airline traffic has gradually been improving, but also that the market has started to accept the company's liquidity position, which we think is quite robust as things look right now, and think that they can withstand the crisis. We have also increased our position in 2 financial institutions, US-based Citizen Financial and Korean-based KB Financials, which we think trade at very, very attractive levels at this point. We mentioned it before, Walt Disney as an asset that we have been looking at for years, that had a sweet but very profitable and short but profitable journey in the fund, 2 months. We were able to take a position below 90 at $85 to $90, but as the stock now trades above 120, we exited the position. So a short and profitable ride for our unit holders there. We have also started to decrease our position in Fortuna Silver. It touched price target, or has almost doubled within a year, mostly driven by its exposure towards silver prices and gold prices, which Jonas touched upon. And we also decided to decrease our position in Telecom Italia and China Unicom, 2 of our telecom operators. Both of them delivered quite disappointing earnings, and we struggle to see catalysts going forward. Telecom Italia has been in the fund for almost 3 years, and as we have a rule to start decreasing positions if we don't see the investment case playing out in the way we thought, after 3 years to avoid a value trap, we started to decrease our exposure towards Telecom Italia as well. Looking at the fund, we have had a quite sharp recovery here since the bottom, strong performance in the fund. Looking at some of the best contributors and some of the detractors year to date, so Roxgold by its own machine, it's the largest position in the fund. We still see attractive upside there. We closed our position in US food retailer Kroger in the beginning of the year as it reached price target. And it's also nice to see that our newly initiated position in German service provider Befesa has started to contribute nicely there. Looking at some of the detractors, much of the weakness is assigned to the underlying exposure to commodity prices that has been weak for OMV and down energy prices especially. And then also Lincoln National has been hit by lower rates and weak markets in the beginning of the year that affects investment income. Looking at the fund, we have 35 positions. We have a large exposure towards smaller and mid-sized companies where we see the largest sort of opportunities globally right now. We're still very highly concentrated within our top 10 positions. 43% of the fund is in top 10. Despite the recent rally, we think the fund is attractively valued, and looking at the sort of average price target across the fund, we see a significant potential still on a midterm horizon. And the portfolio keeps on being quite fresh, with almost 40% of position being less than 1 year. And it's a consequence of us being strict and applying our price-driven philosophy. So we close positions as they reach price target or violate the investment thesis in any way, and bring in new ideas to the fund.
Yeah, so thanks for that. And well, just to sum up before we move into the investment case of Eagle Materials, we're seeing early signs of a rebound of this value asset complex, which has, in our case, also been very favorable. Although I like to point out that these investment cases are not, 100% dependent on that environment. There are also company-specific parameters that fall into place. I think Roxgold may be the perfect example of a stock re-rating, despite the actual environment. But of course, there's been a small tailwind for the fund over the last 2 months, really, since this change started to appear. We have added 2 new positions, and as David mentioned, this is a result of our price disciplined approach, where we never hold assets higher than our price target. We start to scale out already at 80% into the move towards price target. And this has resulted in one company leaving, Eagle Materials is a new position, Disney leaving the portfolio, and also German Industrial Small Cap Norma is new in the fund since 1 month back approximately. We have a pretty balanced approach, but we have a substantial exposure towards cyclical mean reversing situations, since we value stocks at a normalized earnings potential. Many of these names are trading at very depressed earnings multiples, or artificially high P multiples, if you will, in a normalized environment. So this has really been a good environment for us to find new exposures over the last few months. And the stars are aligning, we think, for a more sustained rotation into these kind of assets. We have seen blips of this environment, at some parts of last year, for instance, but this time may be different from a duration standpoint, from an extreme starting point, of course, in terms of relative developments between these 2 market areas. So we're going to move into this investment case, and you see here, this is not about only 1 eagle, it's 2 eagles, and you'll going to see why that is the case in this presentation. And we have been involved in the cement industry before, in terms of being invested in Taiheiyo Cement, for instance, which was a really good ride for the fund a couple of years back. We also have been holder of 2 Korean cement makers historically. So we know this space, we like the space. The US companies has really been too expensive for us to come into. It's one of the best markets in the world in terms of pricing power and so on. So we were very good for us when Eagle Materials did come into our price range in the setback in equity markets of around $50 where we initiated this position.
All right, so Eagle Materials, as you mentioned, cement exposure. They produce products which are essential for all type of construction, repairing roads and highways. They operate in 2 segments, heavy construction materials and light building materials. And as Jonas mentioned, they operate in the US, but one thing which is special about the company is that they also only operate in the US market. 70% of revenues is generated in 10 states, including California, Colorado, Illinois, and Texas. And if we look at their business operations, they're divided into these two segments, so heavy and light materials. Heavy materials include infrastructure, commercial and residential construction, while light materials focuses on residential construction, so mostly wallboards and recycled paperboards. But Eagle Materials is also a niche player in the sense that cement and wallboards are the major drivers of the company's earnings, especially in relationship to peers also, and it's a unique opportunity for investors to sort of get that exposure. If you look at the cement part of the business, the company is well positioned to capitalize on the positive trends that we have been seeing in the cement industry in the US, especially from public infrastructure spending, which represents a major source of cement demand. And for Eagle Materials, that represents almost 50% of their shipments. And we also believe that the company could be a major winner of any type of US infrastructure package to build or repair roads to support the economy in this crisis. And we think that is especially likely in an election year, as that could be an important component of a stimulus package to kickstart the US economy. And when we look at Eagle in particular, in the cement business, it's very interesting to see that they have a local strategy, which we think gives them an advantage versus some of the more centralized competitors. The fact that assets are further away from the coast limits competition and protects pricing power and shields them from any short-term regional disruption. If we look at the wallboard side of the business, they are the lowest cost producer. They have very attractive margin, and they have actually been free cash flow positive even during the financial crisis, which I think is quite impressive. We also think that the environment here should be very supportive going forward. They have the big potential to benefit from any type of recovery in residential construction, as we think that there's a case to build around that the US actually has been underbuilding houses in recent years, so very supported there. If we look at the balance sheet, capital allocation has been very impressive for a long time. The company has handed back excess capital to shareholders, been very shareholder friendly. Actually, since '94, they have decreased the share count by almost 35%. So when we had the opportunity and this asset suddenly traded in our price range, it was very important for us, obviously, in these uncertain times, that we enter an industry like this with a company that has a robust balance sheet, which we think Eagle sort of ticks the box. High interest coverage, strong balance sheet, also in relationship to peers, which give them some advantage to act when others suffer. But this is a story of two eagles. And the question is if they maybe could fly better alone. And in April 2019, the company announced a strategic review of their business, which resulted in a plan to separate heavy and light segment into two different companies through a tax-free spin-off that was supposed to happen this year, 2020. Obviously, due to the corona crisis, this has been delayed, but we think, and it's confirmed by management, this is still very much on the agenda for the midterm perspective. We think that there lies a very attractive opportunity here for the cement business that could trade as a pure play on cement within construction materials to unlock a much higher valuation multiple in relationship to some of the peers. And then for building materials, so the wallboard business could have a much more efficient capital structure by itself if it trades alone as a separate company. And we think that could add several very attractive catalysts that could support further re-rating. So briefly, this very fine asset traded in our price range at below 55. So we accumulated a position between 51 and 55. We have a price target based on normalized earnings potential here at 80, and we had quite a strong ride so far in the name. So a very good example of price discipline, constant work assessing different industries and being able to act and taking a position in fine assets like this that are supported with very attractive catalysts that could drive a re-rating for the midterm horizon.
So thank you, and with that we are finished with our presentation. If there's any questions.
Indeed, there is. Thank you very much, David and Jonas. We have received a question. Hang on, I'll just find it right here. And it's a question about travel and leisure companies. What is your view on these kinds of companies, travel and leisure? For instance, Royal Caribbean, TUI, American Airlines, etc., that dropped 70 to 90% in March.
Yeah, we have obviously been researching these companies as this is our job to research these. When you have these kind of market moves, we really want to take a look at these assets, and we think they are very unique cases. You can't sort of put them all in one box since there are different balance sheets, different situations, different cash refunds to clients, etc. So in our case, we find a large part of that space really interesting, actually, and but we would like to focus on strong balance sheets. That's the clue. That's the key to invest in those companies that are distressed but not too distressed. It's also key to take a look at refinancing issues, and I want to highlight in that area. You also have AirCap, which is an asset that we own, which we bought in the crisis at about $18, I think. And that is a aircraft leasing company, which is a diversified exposure, maybe superior than holding just one airline. And these guys, they lease the aircraft to the airlines basically. We think they are in a much better position than the market at least believed back in March. And that stock has almost doubled here actually since then. But so we think that's an interesting space. But you really need to think about the balance sheets and the refinancing schedules of those companies, liquidity and so on. You could see capital raises in some of these companies. That's not unthinkable. I know TUI they have not raised capital, but there's been speculation of them raising capital. So you clearly need to do a deep dive in their balance sheet structure, I think, at this to get a grip on the duration of their liquidity.